Welcome back to the MPowered Finance Podcast with your host, Sid Misra, Certified Financial Planner. Thank you so much for tuning in. My goal and the goal of this show is to help you better understand the financial system so that you can use it to your advantage. You can use it to help you build wealth and ultimately allow you to live the life that you want to live and not the life that you have to live. Now, in today's episode, I talk about investing and how many people are approaching it in a way that doesn't really benefit them. Hopefully, this episode gives you a framework for how to put your money to work and in a way that helps you achieve the goals that you want to achieve. One of the important questions that we ask is, what do you own and why do you own it? And if you can't answer that question, then hopefully this episode helps you think about that. This is an important episode because of the internet and of new online platforms, access to investing has never been easier. Nearly a third of Americans now have a brokerage account that allows them to invest in things like stocks, bonds, etc. But while the access is there and you can literally buy and sell from anywhere in the world at any time, even the toilet, let's say, most people don't have an understanding of how to actually invest, right? There's no effort involved into buying and selling right now, but the effort has to now come from how we invest and how we put our money to work. Otherwise, you're just kind of investing with no plan, and you can fall subject to market forces, and it could be a costly mistake. So we want to make decisions based on what we want to accomplish, and instead of making decisions based on, what people hear from their family, from their friends, because that's what most people make decisions based on. Oh, a family member has bought this stock or this fund, or I keep seeing in the media that this company is going to do well. A lot of people don't have a plan. They're just, their plan is to follow the herd, follow the next big thing. They have FOMO, the fear of missing out, and it leads them to make rash decisions. The ultimate goal is to build wealth. The goal is not more money. That's nice and that helps. It's not just about the number, though. The goal is to be able to live the life that we want to live, not the life that we have to live. And wealth is the ability to live life on your own terms. Now, for different people, wealth looks different, right? For some people, it's traveling the world, like my family likes to do, being able to go and just experience a new culture and their cuisines and see the sights. For a lot of people, it's just leisure activities, playing golf, tennis, badminton, whatever it is. Others, it's just the ability to be able to live close to their family and their loved ones, or in a broader sense, just owning your time and being able to do the things that you want to do, whether it's one of those things, all of those things, anything else. That is what the ultimate goal is. And so to successfully build wealth, you need to have a plan. How are you approaching investing? And is it tied towards your goals, or are you just looking to make more money? Because those are two different things. And the earlier that you realize that, the sooner that you realize that, the better off you're going to be. And I keep coming back to this question here of what do you own and why do you own it? Can you actually answer that question for your own investments? Take a look at your company retirement plan, your 401k or 403b, or your brokerage account that you have. Do you understand what you own in your portfolio? Do you understand what each investment's purpose is and what it's meant to accomplish and why you own it? Most people have no clue at all. Most people cannot honestly answer that question. And it's because of that reason that I'm recording this episode right now. My hope is to give you a framework for how to approach investing so that it makes it clear to you what you own, why you own it, and in the most important sense, is that helping you achieve your goals? And ultimately, the ability for you to live life on your own terms. And I call this framework the MPowered Finance Investment Hierarchy. It's the process for figuring out what investments fit within your framework and allow you to achieve your goals. Somebody else's framework is going to be different because they're trying to accomplish different things, but you can still benefit by following the process and doing it in the order that I presented to you. Make it specific to you, make it specific to your situation, make it specific for what you're trying to see accomplished. And use this hierarchy to think about new future investments that you're going to make. Use it to reevaluate current investments. Go look at your retirement accounts and make sure that you can answer the question of what do I own and why do I own it. And if you can't answer that question, then go back and use this hierarchy to figure that out. Regardless of the outside noise, you need to be able to answer that question because it's going to help you make better decisions for yourself and ultimately accomplish what you want to. So let's get into it. So to start the hierarchy, we got to look at the foundation level. And I want you to imagine a pyramid. The largest section is obviously the bottom, right? It's the largest, it's the foundational piece. It is what the rest of the pyramid is built upon. And it's one of the most important pieces, if not the most important piece. If that piece is not there, it's not strong enough, the rest of the pyramid will crumble. And that foundation level is your goals. What are you looking to accomplish? We got to reverse engineer that. We got to work backwards so that we can figure this out and find a way to get there. And what's funny is most people don't actually take the time to sit down and figure this out. They're just trying to pick investments and hoping for the best without realizing like, hey, this investment may not actually be the best thing for me and what I'm actually trying to do here. So it's important to set goals. Now, why? Well, unfortunately for us, money is finite, right? Our last name is not Bezos. It's not Musk. Thanks a lot, Dad. It's, we have a set amount of money that we can work with, and we cannot do everything that we want to. That means that we have to prioritize what we're doing. What are the most important things that we're trying to accomplish? Because we only have a set amount of money. And that also means that there's an opportunity cost. If we focus on one thing, it means that we may not be able to do other things. But that focus and setting the goals allows us to stick with the plan when life happens, when distractions happen, when the markets are all crazy. Otherwise, if you don't have a goal, if you haven't figured out what you're trying to accomplish, it's much easier for you to get pulled off course, pulled in different directions. That's why we set a goal. We have kind of our North Star of where we want to head to. And regardless of what the conditions are, the waves and the currents and the headwinds and all of that, we know that this is where we want to be. So some of those goals may be retirement, for the older folks that are listening, securing your life after working. That could be, building up your nest egg to a certain amount. It could be investments that generate income for you to live off of. For the current parents right now that have kids that are, under the age of 18, it could be funding higher education for your kids. That could be a goal that you're trying to achieve and accomplish. It could be saving for a house, right? Maybe within the next 3 to 5 years or 5 to 7 years or something in between, right? There are different goals for different people, but get focused on what you want to accomplish, narrow it down, and figure out what the most important ones are. And then just be intentional about your pursuit of going after that. And one of the big parts about goal setting is figuring out what matters to you and why. And doing this is important because it's going to keep you committed when there are downturns, when there's outside pressure to give up or quit or to buy this stock or this fund, right? You know why this matters to you. There's less of a chance of you quitting, right? If you remember that this is for your retirement, this is for securing your life after working, you're not going to give up. If this is for saving for your child's education to make sure that they can graduate without student loan debt and have the opportunities that maybe you didn't have, you're not going to give up, right? So the why is just as important as what you're trying to accomplish. Figure out what you want to accomplish and why you want to do it. Give yourself that North Star direction that you're heading to, and remember the why, the reasoning for doing it. And within this kind of goal setting level, we also have to figure out what our time frame is. How much time do we have to accomplish these goals? When do you need to have the money available to do the things that you need to do? If you have kids, when are they going to go to college? Is it a newborn 18 years from now, or a 10-year-old who's going to go to college in 8 years? If you have 10 years to retirement, obviously that's going to dictate and drive how you approach things in a different way than someone who's 35 like me, who has 30 years before they're retiring and before they're thinking about that. Understanding the time frame is going to be so important, because that is going to lead into how we plan our investments out and dictate how we actually invest. Right? So set the foundation for how you're going to invest, how you're going to put your money to work. Because things happen, markets have volatility, life goes crazy. But if you can narrow down your focus and stick with these things, it makes it a lot easier to stick with it and actually accomplish it. Right? So in your goal level of the hierarchy, of the pyramid, what do you want to accomplish? Prioritize your goals to the most important things and get clear on them. Understand and write down why it matters to you, and write all of this down. It's much better to look at it. See it on the paper, see it every single day. What do you want to accomplish? Why does it matter to you? Because that's going to keep you focused. It's going to keep you motivated. It's going to prevent you from quitting. And then what is your time frame for doing this? How long do you actually have? Again, like I mentioned before, most people don't take the time to actually do this. And it takes work, right? But most people jump to trying to figure out what investment they want. We recently had a prospect come in who said that he wants to open up an account and buy a certain stock. Now, that's not how we operate at all. We don't just open up accounts for people and start buying things. And I'm happy that he came into our office instead of some kind of sleazy salesperson, because they probably would have done it for him. But when we asked this person why they wanted to buy a certain stock, he said that, I heard it's good and it pays a dividend. And so our next question was, well, do you need the dividends? Do you need the income? What are you trying to solve for? And not surprisingly, this person was not able to answer that question. He was told that this is a good stock to own. It pays a dividend, regularly. They haven't missed a payment, and this is something that I want to own. Well, why? Is that an issue that you're trying to solve for? How much income do you actually need? Do you need dividends? Are you at a point in your life where you need the income, or should you be growing your money to then take income out of? He wasn't able to answer that question properly, and his story isn't unique, unfortunately. Most people can't. Investing first without figuring out what you're trying to accomplish is like taking off in an airplane without having a destination in mind. I'm just going to fly around and maybe I'll get to where I think I want to be. That sounds crazy. That sounds insane. You would never feel comfortable doing that. You'd never feel comfortable getting on an airplane where the captain comes on the loudspeaker and says, yeah, we don't have a flight plan. We're just kind of pointing the bird in whatever general direction we think the destination is in. You got to do the work in this level of the hierarchy to set the foundations. This is what we build upon, right? You're going to have a lot more success when you do this, as opposed to just flying blind, taking off and flying blind with no idea of what you're solving for, right? Put the work in, take the time to figure out the foundation level. What do you want to accomplish? Why does it matter to you? And how much time do you have to accomplish it? After that foundation, we start coming up with the plan. The second level is going to be the planning level, right? Again, we have our goals, we have our why for doing it, our time frame. How do we actually get there? How do we bridge the gap between where we currently are and where we want to be? Again, we're reverse engineering it. We're working backwards. We got to go work backwards to determine what that actual destination is, right? We talked about retirement as one of the goals. We want to secure ourselves after we stop working. What's the number? What are we solving for, right? If in retirement you need X amount of dollars in income every single year, okay, that's the number that we're getting. We got to include inflation and taxes in there. We got to figure out, over, let's say, a 20, 30-year retirement, how much money that actually is. What is that number that we need to get to? College planning is the same thing. What are college costs now? What's inflation doing to those costs? In 10 years, if my kid is 8 years old, what number do I need to be at to be able to pay for their college education? What number am I shooting for, right? If I'm saving for a house in the next 3 to 5 years, how much do I need for my down payment? What do I want to save up for my down payment? So that is, diving more into the weeds of what you're trying to accomplish. And once you have that number, you're figuring out how much you need to save and invest to get there. How much money am I setting aside for my paycheck, for my cash flow? And then how much money am I actually putting to work in the investment to get me to those goals, right? Saving is one thing, but you also have to put that money to work and invest it. We can't just keep it in the bank, right? And we all understand that. That's why we're listening to this episode where we're talking about in the investment hierarchy. We got to put that money to work. And when we're thinking about what investment, right, and where we want to be, we have to think about the rate of return that we're requiring to get there. How much can I expect my money to generate or earn over a given period of time? If I can put more money in, I'm doing a better job of saving and investing. Maybe I don't need as high of a rate of return as if I'm not able to invest as much as I thought I could. Or maybe I didn't have as much time, right? And this is one thing that people, they intuitively understand, but I think it's also important to talk about. Risk and reward are correlated. They're related. If you want a higher return, you need to take on more risk. That is just the way it works. If you're worried about risk and you want to be more conservative because you're worried about losing money, you have to accept lower returns. And time also plays a part in this. That's why we ask you, how much time do you have? If you have a shorter time frame, you have to understand that if there is a downturn, you have less time for recovery. Again, someone like me who's 35 and I'm, let's say, saving for retirement at 65, downturn for the next year, volatility in the short term, it doesn't matter to me because I have 30 years. But if I'm retiring in the next 2 years, that changes completely, right? I don't have the time to recover from that. So we have to think about how much risk in relation to the time that we have to generate these returns. And just as a side note, you don't need, as a baseball analogy, you don't need to be hitting home runs, right? You don't need to be swinging for the fences with every investment. On average, the boring returns are good. They're good enough. Most people that build wealth and have the ability to live on their own terms were not hitting home runs every time. They were not generating crazy returns or finding these crazy investments to invest in. They were just boring, S&P 500 over a period of time, adding money into it. It could be more than enough to generate wealth. You don't need the hedge fund returns or the extra risk involved. Boring is beautiful in this case. And to risk, I want to talk about, there's a difference between how much risk you think you can handle and what you're actually able to handle. When things are going well and the market's doing well, it's very easy to sit there and say, oh, I can handle a lot of risk. Yeah, markets are going up. I can handle risk totally. But what happens when that's not the case? What happens when things aren't going well? I'll give you a quick example of a real life story that we have. My dad, when he turned 60, we bought him an experience called Fighter Pilot for a day. And I ended up buying one and doing it with him, going up in these little turboprop fighter jets, not fighter jets, but fighter turboprops. because we thought that we could handle it. We grew up, we are big aviation fans. We love Top Gun. We love all those kind of movies. I go to amusement parks and get on the roller coaster. So as somebody who has not been up in that kind of airplane, I'm on the ground. I'm like, I got this. This is going to be great. Call me Maverick. I'm the man. I'll win. I'm gonna shoot you down metaphorically while we're dogfighting. We thought we had the right stuff. It turns out we had the wrong stuff. We were so wrong. We get up in the air, first of all, in these tiny planes. I'm a big guy, cramped in there. You can feel every single bump and turn and G-force. Luckily, there were bags in there to vomit in because we vomited a lot. We didn't get any in on the cockpit or the controls, but we basically spent the entire flight just throwing up because physically we couldn't handle it. We got back on the ground and we were kind of sick for like another day. But that's what I'm saying. It's very easy to be on the ground, to look at a video of it, to look, even in person, look at a plane go and say, oh, I can handle this. When you're actually in it, it's completely different. And I want you to think about right now, 2020, March, when COVID really shut everything down and markets dropped over 30%, what were you thinking? How did you handle it? Were you panicking? Were you losing your mind, going, "Oh my God, I can't believe what's going on. The whole world is crumbling around me"? Or were you like, "Yeah, this is kind of short-term volatility. It is what it is. We'll get through it"? How did you handle that? That's a good way for you to think about this, right? Again, what you think you can handle is different than what you can actually handle when in the situation. So make sure you account for risk and account for your ability to actually handle it. Now, another part of the planning process that I think gets ignored, the whole planning process gets ignored really, but one is defining your success, right? Hitting your number, defining what success looks like. So it could be hitting your number, making, being able to generate consistent returns or consistent income from the investments that you have. But I think just as important as that is, how do you define progress? What's progress to you? If you have, let's say, 10 years until the goal that you've set, how do you measure progress over a year or 3 years or 5 years or 7 years? How do you know that you're on the right track and moving in the right direction? How do you know that you're doing the right things? It is really important to define this beforehand while you're doing the planning process. If you don't, and you're in the moment again, and markets are crazy, or there's just a lot of chatter outside about different things, you may be caught up in the market turmoil. You may be caught up in chasing returns or the FOMO of missing out on different things. You may be led astray because you haven't defined what success looks like, and you may not actually think that you're on the right track, even though you are. So I think it's really, really important that during the planning process, you take the time to define what progress looks like. How do I define that? And if I'm not on the right track, how do I correct that? That's something that you want to remember as well. You want to be able to monitor this over a period of time to make those course corrections, right? If you are traveling in a certain direction, the winds shift, the currents shift, things happen, it can push you off course. How do you know that you're on course? And if you're off course, how do you correct that before it's too late? If you just kind of set it and forget it, you may hit that period of, okay, 10 years is up, but I could be in a completely different or wrong place because I just didn't monitor it. I set the investments and just completely forgot about it or thought it was automated, and I haven't done enough to, one, define it, and two, to maintain that and to monitor it over a period of time. So you want to be able to define what progress is. You want to be able to track that progress over time and adjust if you need to, right? Is this investment working out? Is this strategy working out? Have my goals changed? And do I need to reevaluate how I'm approaching my investments because my goals have changed? Right? So the planning part of it is so important. Again, we build upon the goals, we build upon the why to go to the plan. How much do I need to be saving and investing? What rate of return is required? How much risk can I take? How much risk can I actually handle? And then how do I not only define success, which is most likely just getting to that end goal, but how do I define progress so that I know I'm on track? And if I'm not, then I can adjust, right? We have to define this in the planning section, because that's another step towards figuring out what the actual investment is. And again, it's another step towards actually getting to our end goal. So now that we have our foundation level of goals and why, we have our planning level, the plan from getting where we are to where we want to be, the final level is the portfolio. This is where the investments come in. And funnily enough, right, this is the top level of the pyramid, the smallest part. This is usually what people skip to. They're just in a hurry to go, what investment? Okay, this stock, this fund. They go here immediately. This is the last thing that they should be looking at. They need to be going back towards the first and second levels. Build a foundation, build a plan, and then go to your investments, right? It's the last level for a reason. Once we've defined those things in the foundation and the second level, what are the investments that are going to fit within that framework? What investments fit my planning level, the rate of return that's required, the subsequent risk level that I can handle and tolerate and accept? Now, I believe that you can use this hierarchy for things like real estate, for businesses. Again, you're just kind of defining what you want to accomplish. You're coming up with a framework and a plan for that. And so obviously for real estate and businesses, it's going to be a little bit different, but still the framework is there. I'm focusing on things like securities, stocks, funds, mutual funds, ETFs, because that's what I know and that's what we work with on a daily basis. And I think there's a lot of different choices out there. It can be overwhelming. You watch TV or something, CNBC, you see the ticker symbol at the bottom. You're like, I just see a bunch of letters. I see a price next to it. How do I figure out what to buy? Again, you have your framework, right? You have your goals, you have your plan. Now, when you start thinking about it, what's the best thing for me? Some people like individual securities, individual stocks or bonds. They have figured out the first two levels of the foundation, and for them personally, they like the individual securities like that. Let me buy XYZ company or let me buy ABC. It does require another level of understanding that specific company, its financials, the industry, kind of the trends and how things are looking, the forward look of it. But also, the downside to that is they're concentrated positions. You may have all your eggs in one basket. It's a lot of work too, to sit there and go through the financials and understand a specific company position. Most people have a lot more success in a broad-based approach, looking for diversification, all different parts of the market. Maybe your investment and portfolio building is going to account for that, right? You don't want to be spending the time looking at each individual company because you just don't have the time, right? So maybe you're going to look for something that's more broad-based, an ETF or an index fund, a low-cost option like that. Maybe you want more active management. You like a mutual fund that's going to still give you the diversification, but maybe it's a specialized strategy. So those are things that you want to consider in the portfolio section. Do I like individual? Do I like more of a broad-based, diverse approach? Do I want to blend them together? Do I want to ask someone for help, a professional that knows how to do this? And again, the professional is going to follow this hierarchy. They're going to figure out what you're trying to accomplish. They're going to figure out what your risk tolerance is, your time frame. We're going to come up with a definition of progress and success. But the professional is going to do that. That also means that you should be doing that as well. It's really only when you figure out the first two levels that you really start making these investment choices. And again, fitting that within the framework of who you are and the framework of what you've figured out in the first two levels. So again, as a reminder, when we go through the investment hierarchy, we're looking at number one, what are the goals that we're trying to accomplish? Why does it matter to me? And what's the time frame that I have to accomplish these in? The second level that we build upon is the plan. How do we actually get from where we are to where we want to be? And build that framework that allows us to then, in the last level, the top level, the portfolio, to figure out investments that are going to help us achieve that goal. Are we coming up with that? Maybe we're using a professional to help us with that. But again, whether it's you or a professional, this is the hierarchy that should be followed. And like I mentioned before, this is not a set it and forget it exercise. This is something that has to be monitored regularly. Life happens. Your goals change, your plans change, investments change. You want to be able to adjust. You want to be agile enough to be able to adjust, but you also need to have the awareness. And if you're not monitoring it regularly, you don't have the awareness. You don't have an awareness of if this investment is underperforming, and maybe I got to get rid of it to find something that's better. Or maybe your goal has changed, and thus your plan has changed, and the other parts of the pyramid have changed, right? Keep asking yourself, what do I own? Why do I own it? And does this help me accomplish the goals that I'm trying to accomplish? We all have a tendency of trying to overcomplicate things, but I think this is a simple framework. It's really just three levels. To me, it's an easy way to go about the investment process. It gives you an idea of how to approach it in a way that's going to get you to where you want to be. But don't overcomplicate it. There's no secret investment, there's no secret formula or company or strategy that's going to get you extra returns or do anything. Boring is beautiful. The ETFs, index funds, they're boring and they're beautiful, right? If you can find something that gets you 7 to 9% a year like the S&P 500 does, if you can find something that gives you the average returns of the market every single year, you can build wealth on that. You can own your life, you can own your time, you can live the life that you want to, right? You don't have to overcomplicate it. So think about this hierarchy, the order in which you're following it. Most people are jumping immediately to the top section, which is the portfolio, which is absolutely wrong. You have to follow the order. You got to go from the bottom up. If you're ignoring it, it means you're flying blind. You have no flight plan. You have no idea really where you're going. You're just chasing returns, and you have no idea of what you're actually doing. Utilizing the hierarchy means you have a framework to accomplish the goals that you set out for yourself. So my question to you is, do you follow this hierarchy? Are you asking yourself, what do I own and why do I own it? And if you can't answer these questions, if you know that you're not following the hierarchy, can you afford not to? Can you afford to just fly blind without a flight plan and hope to get to your goals? Hope to achieve what you want to accomplish? The answer for most people is no, they probably can't. So this is a good opportunity for you to reevaluate that. That's going to do it for episode 11 of the MPowered Finance Podcast. Thank you so much for tuning in and for your support. And always remember, if you empower your finances, you can empower your life. Thank you and take care.